Hi, this is Lance Edward.
Yeah, this is Randy Lupke.
Illusion there, and this is Financial Independence, a Better Perspective. And today's topic is one I think you'll find very, very interesting with regards to what is the ideal investment? Ideal investment. And I think we're going to start today. Randy's going to interview me, my perspective. Then I'm going to turn it around on Randy. We're going to get his perspective on the ideal investment. So, Randy, why don't you take it away?
Excellent, excellent. All right, Lance. Well, this is going to be a good one because people often, as a financial consultant, are coming to me and saying, hey, I want this attribute and this attribute and this attribute of a financial investment. And many times, of course, they're contradictory. So I know that you and I have talked a lot about this in the past, and you have a really interesting philosophy, a really interesting way you look at what is an ideal investment. So I think to start out, why don't you just give us the overview of what that ideal investment looks like and works like, and how somebody might identify it.
Yeah, thank you, Randy. I was taught this, of course, I come out of the real estate space, and I was taught this, in my very first mentor in real estate investing taught me this formula for the ideal investment. And it's simple. Let me just share with everyone. You take the 5 letters in the word ideal, I.D.E.A.L, and it becomes an acronym. So the 5 attributes of the ideal investment has I, income. It has D, depreciation. It has E, equity. A, appreciation. And L, leverage. Income, depreciation, equity, appreciation, and leverage. And you use this metric to line up any particular type of investment class that you're looking at, whether it's real estate or buying a business or investing in the stock market. You can apply it against this ideal attribute. So let's go through these. First of all, income. Income means passive income. An investment generates passive income. It generates mailbox money. Depreciation. Depreciation means, and Randy, you know all about this. This is, the IRS gives us, particularly real estate investors, a depreciation benefit. It's a loss we can claim on our tax return that offsets our active income. Very powerful tax benefit, depreciation. Now, it's a paper loss. Let me be clear about this. It's a paper loss. It's not actual. It's a paper loss. And one of the things about depreciation, I'm not going to go through the math here, but you can actually buy, in the case of real estate, you can buy enough real estate that the amount of depreciation losses that you put on your tax return every year can actually offset the amount of income tax you would pay on your active job income. You could be paying 0 tax over there. You could literally wipe out your tax return, your tax obligation from active income by owning enough real estate because of the depreciation benefit. So that's the second attribute. And then the equity, what that really means is, in the case of real estate, when you have a mortgage on a piece of real estate, well, every month you're paying down the mortgage. More precisely, your tenants are paying down the mortgage for you. And over time, that becomes equity that you get as a bonus just by owning that real estate, right? And it's just and people lose sight of that. I mean, that gets to be sizable as you pay it down. The A, appreciation. Well, appreciation means values go up, and in stocks, you have appreciation on stock values. And in real estate, we have appreciation. And depending on the asset class you have, if you're like me in apartments or any kind of income-producing real estate, you can have market appreciation, where the market will drive it up. But you can also have something called forced appreciation, where you can force the value up by raising the rent, raising the occupancy. It's very predictable. And then the final attribute is the one that everybody loves, is the leverage, L, buying an investment using leverage. And or OPM, other people's money, and leveraging your own know-how and other people's resources. And so let me give you some examples, Randy. So this is what I was taught early on. So if you take, let's say, somebody wants to buy stocks. Okay, well, we're going to line it up against the 5 attributes. Does the stock produce income? Well, some do. They have dividends.
No. Dividends, right? Yeah.
No? Yeah, you have to have dividends.
No depreciation.
Yeah. Well, a stock, no depreciation. Will you have equity? Well, yeah, whatever you have in it is your equity. Will you get appreciation? You hope so, right? That's like one of the main attributes is appreciation. Can you buy it? Can you buy it with leverage? Yeah, you can do margin. You have a brokerage account. You can do stock margin and leverage it. I know you don't like that as a technique. I don't think anyway, Randy, but you can borrow against it. So you get some of the attributes with stock. Let's say you want to buy a business. All right. Does a business provide income? Well, yeah, that's why we're buying it.
Well,
can you claim depreciation?
Right. Yeah.
Some parts, you got some equipment, some parts of it. But if you got a service business, there's no depreciation.
That's true.
Is there equity? Yeah, equity, will it appreciate? Well, if you're raising the income and if it's a true business, I mean, it's managed by others, not you, it's not your job, then yes, you can get appreciation in it. Can you buy it with leverage? Yes, you can do seller financing, you can borrow money to buy businesses. So let's have some of the attributes. By the third class is real estate. Now this is my space. So does real estate, and let's just talk about apartments, but any kind of income producing real estate. Do apartments provide income? Absolutely. That's one of the main aspects. They're called income producing real estate. Can you get depreciation tax benefits? Absolutely. Can you build up equity? Yep, because every month my renters pay down the mortgage, which is building up equity without me doing anything. Can you get appreciation? Yeah, you get those two types, market appreciation and forced appreciation. One of the things that actually attracted me, first of all, was the predictability of it. And then finally, combine with leverage. Absolutely, that's the only way I'll do it. Seller financing, private money, mortgages, etc. Nothing down deals, ultimate leverage. So when you line them up, really, real estate comes down as one of the very few vehicles that satisfies all 5 attributes of the ideal investment. And so that's my definition, Randy. That's what got me started in apartments all these years. So what are your thoughts about that?
Okay,
what do you think about that, Randy?
Yeah, so this is pretty interesting, the way you've laid it out, Lance. Frankly, if I think about all the different types of investments that one could become involved with, to meet your ideal description, there's nothing that works better than real estate that fits this ideal, right? Again, if let's just take something really simple. Let's say you put money into a savings account, right? Now, technically, it's not an investment. When you put money into a savings or a checking account, technically, you've loaned money to the bank, right? But we're going to call it an investment just to put it past your cash. So if I put money in a checking account, do I get income? Absolutely not, right? You don't get it. Do I get depreciation? Absolutely not. Mm-hmm. Do I have equity? Yeah, the money I put in, which was mine, is still mine, so I have the equity. Do I get appreciation? No, because there's no return, and there's absolutely no leverage. So when I look at a checking account compared to your ideal, all I get is equity. I get 1 out of 5 things. Am I getting that right?
That's exactly right. And that's when it kind of was a slap in the face for me. And of course, I learned this back when this is many years ago, going back to 2000, 2001 or 2, when I was first learning this stuff, Randy, and had a job and, going the corporate route and was, putting my money into, I guess at that time, a 401k. Nothing wrong with 401ks, but I learned this, started stacking up against my 401k. Wait a minute. I don't have all these attributes. And that's what literally led me into real estate. And I would add this to it. This same conversation, a lot of people get started in real estate because they want to go wholesale. That's a whole other strategy, wholesale properties, fix and flips or wholesaling.
Fix and flip.
Well, that's fine. Yeah. And they can generate chunks of cash and nothing wrong with cash. Chunks of cash. The only problem is every time you sell that piece of real estate, you kill the golden goose. You just cut his head off. Now you got to go start all over again. And so I'm one of the preachers. Go buy these assets, buy the asset, and enjoy all the attributes of the ideal investment. And you start. And I'll just I go into the math. I can easily show how anybody can go out using the ideal formula and buy pretty real estate in pretty areas and make a 15% annual return on their money. I mean, simple. Buy retail price stuff. 15% APR on your money. because you've got all the attributes coming in, taking into account your depreciation, your mortgage pay down, appreciation, the cash flow. It just, I've never found anything that stacks up to it with regards to, certainly comparison to a business or buying a stock, etc. And I do those. I do those too, but nothing compares with real estate.
Yeah, so let's do this again. I love this. Let's do this exercise again, and let's go through the stocks a little more carefully, but using your ideal filter again. So if I buy stocks, they can produce income if they're dividend-paying stocks, because dividend-paying stocks are kind of like a rental, right? You buy them and they pay rent, they pay dividends, so that works, right?
Yeah.
Once again, there's no depreciation in stocks, right? There are some stocks like REITs, real estate investment trusts, that own real estate, and inside there they'll get the depreciation, but there's no direct depreciation that you receive as an investor in a stock that you can use to offset the income that you earn, right? The equity, again, is the money you put into it, so the equity is the equity. The appreciation, again, this is what we hope for, right? In the stock market, that's called, buying long versus buying short, right? We're buying long, hoping that it'll go up in value. And you're right, you can get leverage with stocks, and you're also right, I'm not a big fan of that. And the reason I'm not a big fan of it is because of something called a margin call, and we can talk, another day about, borrowing in stocks and borrowing in real estate, whatever, but leverage in securities world is pretty risky versus leverage in real estate. I think is the opposite. I think it's what's the opposite of not risky? Not risky, right? It's better to do, right? Yeah, because you're protecting yourself by having as little of your cash in the property, right? It's not risky. Double that. So again,
and that's the thing. Let me go ahead. I'm going to come back in a minute. I got a thought I had.
Well, I was just going to say, so with the leverage part of it, if I own stocks, those companies can literally go out of business, right? Big companies have done it in the past. They've gone from being worth a ton of money to literally filing bankruptcy. And with real estate, you don't have that, right? If the property burns to the ground, you probably hopefully have insurance on it. There's just no way that you're going to lose 100% of your money. It's not going to happen with real estate.
And that's the point I wanted to add, because I have 2 points you just triggered for me, Randy. So first of all, on leverage, and when you're say borrowing money, and depending upon how you approach it and what type of asset class you're working in real estate, you have types of leverage. You can have recourse or non-recourse loans. Recourse means we have to personally guarantee it, right? Which means, and non-recourse means we don't personally guarantee anything. So in recourse, if for some reason the property can't make the mortgage payments, then the lender can come after take the property back and come after us personally. That's like every home mortgage has recourse in it. Non-recourse, which is the world I play in, is I don't personally guarantee anything. If the property for some reason can't deliver or can't make the payments, then the lender gets the property back, which is proper, but they can't come after me. So I insulated myself from that risk exposure. And now the other thing I want to add, talking about, is a lot of times I get questions, a lot of people, go back to the 2008, 2009 recession. A lot of people got hurt in real estate because they were not following the basic rules of acquisition. They were overpaying. They probably were over leveraging. They just weren't, they didn't buy for cash flow. They were buying for future speculation, basically. They were speculating. They were speculating solely upon the appreciation, right? And certainly, boy, in your part of the country, that certainly was the case, but all over the country, this happened. They were betting on speculation. That's not how I recommend. That's a strategy. That's like buying stock market. That's like buying stocks, hoping they go up in value. That's somewhat speculation.
That is.
So I look at, let's go to the first attribute, income. So when I'm buying, the property has to have cash flow. It has to have a cushion. It has to have cash flow. So at that point, I don't care what the values are doing. If the values were to go down, like we're in the middle of COVID right now, and there's a lot of people the same phenomenon is playing out again. Mark my words on this, Randy. People have been overpaying for real estate leading up to this COVID recession, and they're going to find that when the income goes down, they're going to, not going to be able to make that debt service. They're going to lose these things because they overpaid and they over-leveraged. And so at the end of the day, and my point is this, when you're buying income-producing real estate, you buy it, you make sure you got cash flow. You want the value to go up, but if something happens and there's a downturn in the market and the values go down, it's still cash flowing. You can ride it out. That's your cushion. You can write it out. And that's an important part about real estate is the income, the cash flow part of it.
Yeah, and that cash flow is to be there from the get-go. I want to take one more swing at this, and then I want to go back and visit what the ideal investment would be from my perspective. But I want to take one more swing at it with real estate. So, because I get this question often, right? So we're talking about apartments and rentals and investment property, income property. How does this work with your home? How does the ideal investment work like with the home you live in, right? Because the home we live in doesn't produce any income, right?
Nope.
And it doesn't have any depreciation.
Nope.
Okay.
You do have equity. You
have equity.
You have equity, whatever down payment plus you paying down your mortgage, I guess that's your equity.
Yep.
Appreciation. You hope so, right? You hope so.
Okay.
And can you buy it with leverage? Yeah, absolutely. You can buy your home with leverage. So it's really, but it doesn't have any cash flow. It's not paying you, and so you're having to go you're having to go generate income somewhere else to pay the mortgage on your home. So here's an idea. Why don't you go take whatever cash you put into your home, go buy an apartment building, and use that cash flow to pay your mortgage on your house. Now
I think that's a very solid idea. I think it's a very solid idea. I don't know where I got this platitude from, but I say, most people work to earn money to buy things. Wealthy people work to earn money to buy things that make money, right? And so if, instead of buying a house, right, the thing, I would buy an apartment. The apartment would pay income, and then the income would pay for my house. That's more sustainable. That's a better, smarter way of doing it, I think.
Oh. I think I would challenge everybody. The next time you're tempted to buy a thing, a car,
yep,
and maybe you're gonna pay all cash for this car. Well, here's an idea: take that cash and use it with leverage to go buy, an apartment or an income piece producing real estate, and use the cash flow off that apartment building to and then go get a loan to buy the car and use the cash flow to pay the debt service on the car. Now you've got an asset paying for this thing, which is appreciated the moment you drove off the lot, and you got zero credit for that depreciation. That, to me, is the way to play. And I want to add one more thing, Randy, and I'm going to turn it around on you, on your idea of your perspective, the ideal investment. But
yeah.
And the other thing I want to talk about the L, the leverage in real estate is such a big part of it, because you can buy real estate using none of your own money, none of your personal assets. You can go out and buy rental houses, apartment buildings, strip malls with 100% leverage, getting cash flow off of that, and then using that to maybe pay the mortgage on your house. And one of the things I was taught early on, and I'm going to share this, and I'm going to come back to you. I'm going to let you share your perspective. Is, real estate is something we take money out of, not something we put our money into. Use other people's money, OPM, and that. Ever since I got stuck in my head, that's like the only way to fly. Is the way I've looked at it. All right, so that's my perspective of the ideal investment. Now, Randy, you have your perspective of the ideal investment, which I found very, very interesting. So what do you consider the ideal investment?
Yeah, so I take a little different twist on this. So, in fact, Lance, I would call your ideal investment the way to describe the ideal investment in real estate. And the one I'm going to lay out to you now is, I think, a little more generic. But and I'll give you the 5 bullet points, and then I'll come back and drill a little bit deeper on each one of them. So here's the ideal investment. It's 100% liquid, it's 100% safe, gives you 100% rate of returns, that are 100% tax efficient, and it's 100% passive. Right? So safe, liquid, awesome returns, tax efficient, and I don't have to do a darn thing. It's passive.
That's beautiful. I want one.
Yeah, so does everybody else. Right? and that's the point. I mean, I have outlined what ideal would be, but the reality is ideal doesn't exist. It just isn't possible, right? So if that's ideal, and if that ideal investment doesn't exist, it means with any investment, you have to be willing to compromise something, right? Something has to give it up. So let's run the filters again. Let's do the simple checking account. If I put money into my checking account, is it 100% safe? Sure, right? $250,000 worth of federal insurance. So we're going to call that safe. Is it 100% liquid? Yeah, I can ATM it. I can write a check. I can go get a withdrawal. I can get my money anytime without any fees. It's certainly 100% liquid. Do I get 100% rate of returns on it? Absolutely not. Right? I'll get nothing. In fact, with most checking accounts, if I don't have enough money in the checking account, they'll charge me fees for it, right? For taking my money. Is it tax efficient? Absolutely not. If I did get paid interest, it would be taxed at the highest interest rate at ordinary income rates. But is it 100% passive? Yeah, it is, right? I don't have to do a darn thing. So out of the 5 tests, it's safe, it's liquid, and it's passive, but it's not tax efficient, and it doesn't have any kind of a return. So 3 out of 5. Okay. Now let's take real estate, income property. So we differentiate, I think, in the last argument, that there's a difference between your home and income property in terms of real estate, right? So if we take income property, is it 100% safe? No, it's kind of, right? Kind of. I mean, but no, because you could lose renters, and the property could appreciate in value. That could happen. But in the case of like comparing to a stock, where a company could literally file bankruptcy, go out of business, and your investment become worth nothing, with real estate, most of the risks associated with it you can insure and protect yourself, right? You can get homeowners insurance if there's a fire, or liability insurance if there's an accident. So there's lots of ways to protect yourself if that happens. Is it liquid? No. That's one of the areas where real estate really, the minute I buy a piece of real estate, if I'm going to resell it, I'm going to pay closing costs, maybe realtor fees. I'm going to pay expenses. So there's that. It may be weeks, months before I get to sell it. It's not very liquid. Does it get great returns? Yeah, it does. For all the reasons we were describing, right? Because you're getting cash flow, because you're getting depreciation, because you're getting appreciation, you're getting all these things going on, and simultaneously you're going to get great rates of return. A lot of those are going to be tax efficient, so it falls into that model very well. Like you said before, depreciation could offset all the cash flow income, so I get all this money coming in to spend, but I don't have to pay any taxes on it. That's pretty ideal. And then finally, is it passive? No. Right? IRS says it is, but anybody that owns real estate knows it's not. So, your thoughts on that?
At best, you got to manage the managers. At best. Yeah, no, I do. I think, I was thinking some here. I think the passive part is, now if you want purely passive in real estate, go buy some shares in a REIT, or go invest in somebody. Go invest in, be a private investor in somebody else. But syndication. When I'm talking about apartments, I'm talking about at least you got syndications. You got to manage your managers. It's a business. It is a business, and you can have your property manager doing the day-to-day, but you've got to keep an eye on that. The tax efficiencies, I think you know more about this, but I don't know there's any vehicle that has more tax benefits than real estate. Is there, Randy? I guess look at everything that's been stacked up with depreciation, long-term capital gains, passive income considerations.
Yeah. So on the tax side, there are things that are as efficient as real estate, but you're going to have more risk. So say like oil and gas leases, right? Farmland and so on. You can get all the tax efficiencies, but you have much greater risk, and it's complex. And I mean, heck, just a few weeks ago, they were selling oil for, no, they're actually paying you to buy oil. They're paying you $35 a barrel to take it away, right?
Yeah.
So we're that, I don't think you're going to be paying your tenants to stay in your apartment. I don't see that happening.
No, I don't see that
So
happening. No, I don't see that one. I would make a comment on the safety side. You mentioned, of course, there's insurance can insure against a number of the risks side.
Yeah.
Casualty insurance if something burns down, or casualty insurance. There's also, a lot of people don't think about this, because this is what I do. Income loss insurance, just like a business.
That's right.
If something happens, let's say, if one of the buildings were to burn down, well, the insurance company will pay to rebuild it. But what happens to that lost revenue for that 10 months it takes? Well, you can buy income loss insurance. It'll keep paying your rent. It's an insurable event. So there's a lot of ways to mitigate that. Market forces, we just seen an example with COVID. People can't pay their rent. That's an issue. And there's actually, this is kind of a sidebar, but there's been a kind of a debate about should income loss insurance kick in those kind of events. But but nevertheless, I think I like your assessment. And as I was listening to it, Randy, maybe you can comment on this. It seems to me the more passive the investment is and the more liquid it is, probably a correlation with the lower return there is. And,
that's correct.
And I would also probably say the more of these you get, the lower the return is going to be. Is that true?
Well, the first part's true. I don't quite understand the second comment. Can you just restate that maybe?
Well, the more liquid, the more passive. Of those two, the more liquid, the more passive the investment is, the lower the return is going to be.
Oh,
that's
okay.
A true statement,
okay. So
correct?
yeah. So as you increase liquidity and you increase the passivity, then you're going to have to accept lower rates of return. And that in general is a true statement. Yep.
And so along the spectrum,
or you could increase risk too, because let's stick stocks again. So stocks are very passive. You just go buy it, and you don't have to feed it, water it, you don't have to do anything. But you could get great rates of return, or you could lose your butt, right? So they're very passive. In fact, they're so passive you're just basically going along for the ride, right?
Yeah, that's a great point. Your checking example, because you've got the FDIC insurance that pays nothing, or even you put it, I guess money market account, whatever 0.2% or whatever that is. But
exactly, yeah.
I think that's spot on. So there's this trade-off everybody's making, and I imagine, I don't know, you tell me, that one of the biggest trade-offs people are making, whether they're going to be active versus passive in the investment. Is that a big choice, a big initial choice by people to make?
It is, and just stepping back, my bigger point of all this is when you're making an investment, run it through that filter of those 5 elements of the perfect investment, and realize you're not going to get all 5, and ask what you're willing to give up, because you're going to have to give up something, and that way you won't get disappointed, because you can't buy into like you said, a liquid passive safe investment and expect huge rates of returns. You're just going to get disappointed. It doesn't exist, and it's not going to happen. If anybody tells you that it is, they're lying, right? It's just not there.
Yeah. All right. And so I think we've got two I don't want to call them perspectives. I guess 2 perspectives on the ideal investment. But I think
2 filters.
I think you're spot on. I like this. I like this a lot. 2 different filters. Exactly. It's 2 different filters. You've got to make some choices. I guess your personal preference at each individual, what are they willing to trade off, and getting return on their money.
Yeah. Thinking about
All
it,
right.
your ideal is more like a pass fail, because if an investment property doesn't pass all 5 of your tests, it fails, and you probably shouldn't be buying it, right? If it doesn't have the income, the depreciation, the equity, the appreciation, and the leverage, then it's not a deal for you. Is that fair?
Yeah, that's certainly, and I got to say I'm biased, but it stacked the deck towards real estate. That's why I'm a real estate guy. At the same time, but I do own a business, and although it's, and I do have stocks and mutual funds, but I tell you, as you know, my focus and my attention is going into real estate.
Yeah.
Constantly going into real estate. It's scalable and has all these other attributes we can talk about as well. All right, Randy, this has been really good. Are there any final thoughts you have with regards to this? This is your day-to-day bread and butter, and having these conversations with clients and investors trying to make decisions. Any final thoughts?
Yeah, well, and thank you for that. That is exactly what we do and why we do it. We work with business owners, successful business owners, and real estate investors, and we do that as financial advisors for two reasons. One, the investments are good, and two, that those types of people, entrepreneurial people, they're marvelously complicated, right? They need help. And so if and that's okay, right? Yeah, you waving your hand. But the alternative is if you're going to have a job, if you're going to just do things that are passive, then you don't expect to get the types of returns that are going to change your life. And owning your own business, that's can be a life-changing event. Owning real estate over time can be a life-changing event, and you want to work with people that can help you to facilitate those types of changes in your life.
Perfect. All right. Well, this has been excellent, Randy. And for everyone, for this episode, we're going to get the show notes. We're going to post it on this episode, and access to other archives and free bonuses. Please go to our website page, fibetter.com, fibetter.com. And while you're at it, if you're listening to this on iTunes or Stitcher, how about giving us a great review? Let us spread the word on what we're doing out here. And if you're more interested in some of my stuff, you can go visit lanceedwards.com. And Randy, if they want to plug into your world, what they should be doing, how do they find you?
Yeah, our website is lifetimeparadigm.com. So lifetime, LIFETIME, and paradigm is the hard one, PARADI, G as in George, M as in Mary.com, lifetimeparadigm.com. And when you get there, you'll see an offer to enroll in our financial independence toolkit. Take it. It's an amazing toolbox full of good financial toys and educational videos and things that'll help you along your way, and it's 100% free.
Excellent. Go check it out, everyone. It's great stuff. And, of course, you can access all of this. If you didn't get all of that, go to fibetter.com. You'll find the links on the page there. Until the next time, everyone, go make yourself financially independent. Take care.
Thanks, Lance.
Thank you.